Hi, and welcome back to our discussion of efficient market theory. In this segment, we'll go over the truth behind actively managed funds and why it pays to become a passive investor. Did you know that 80% of actively managed funds lag the appropriate index? That's a whole lot worse than pure random luck would suggest. On average, managed funds fall about 2% below the appropriate index returns. This is just about the combined cost of active management we discussed before. Managed funds have higher variability of risk. For instance, if the market delivered a 10% return, individually actively managed funds might vary from 0 to 15%. Why take all that risk? Winners don't repeat. If the few that beat the indexes repeated their performance consistently, then we'd have to admit they were displaying some kind of skill and cunning. In fact, it doesn't happen any more than random chance might dictate. Managed funds have higher tax liability. On an after-tax basis, they don't have a snowball's chance to beat the index. Passive investing is the thinking investor's choice, the way to participate in the world's securities markets. Specifically, the use of exchange-traded funds or institutional class no-load index funds provide the following advantages. It's the lowest cost, lowest risk, and incidentally the lowest tax cost way to participate in the world's markets. The Investor Solution pension plans contain only passive investments. Together, these funds allow our pension investors to obtain exposure to almost all the world's attractive markets. All this translates to the highest probability that you'll have a successful investment experience over your investment career. Our best guess is that you'll increase your expected return by about 2% per year. Just by eliminating the cost of active management at the same time, you'll reduce your risk. You got to agree, that's not a bad day's work.